Welcome to this video on capital budgeting techniques. I'm your presenter, Moya Kihumba, on behalf of Institute of Finance and Related Studies. There are two major methods of evaluating investment projects. One of them is non-discounted cash flow technique, which has the inherent disadvantage of not considering time value of money, and the other is discounted cash flow method, which is superior than the other in that it considers time value of money. There are three major discounted cash flow methods. We have the internal rate of return, which is the subject of this video, the net present value, and the internal rate of return, which are in separate videos. What is the internal rate of return? Internal rate of return is the discount rate that would equate the present value of expected net cash flows with the initial cash outflow. In other words, the internal rate of return is that rate that equates NPV to zero. What we are saying is, if we have our initial cash outlay or initial cash flow in year zero, C0, it should be equal to discounted cash flows of all the time periods. That is, our initial cash flow should be equal to the sum of all discounted cash flows. Or when we less initial cash outlay from sum of present values of cash inflows, we should end up with zero. How do we determine whether to accept a project or not using the internal rate of return? If the internal rate of return is greater than the required minimum rate of return, then the project would be accepted. Otherwise, we reject the project. In summary, we are saying that we accept a project if the internal rate of return is greater than the minimum required rate of return. We reject if the internal rate of return is less than the minimum required rate of return, and it would be 50-50 if the two rates are equal. But how do we compute it? There are several ways of approximating IRR. We have the graphical method, we've got the trial and error method, and we've got the interpolation method. Interpolation method is basically an advanced trial and error method, in which case we try to solve the IRR using the present value tables. To interpolate is to estimate a known number that lies somewhere between two known numbers. There are three steps to interpolation method of computing IRR. The first one is to calculate the net present value using the company's cost of capital. Invariably, most of the questions that requires you to compute IRR will give you a discount rate. We use that discounting rate to compute NPV of a project. The second step is to compute another NPV but using a different rate. But how do we choose this second rate? If the NPV obtained using the first rate is positive, the second rate should be greater than the first one. But if the NPV obtained using cost of capital is negative, then we try a lower rate. Our step 3 is to estimate our IRR using the formula which is given here. As we say, IRR is approximated as A plus NPV of A everything divided by NPV of A minus NPV of B times B minus A, and we express that as a percentage. In this case, A is the lower of the two rates used, B is the higher rate used. NPV-A is NPV obtained using the lower rate, whereas NPV-B is NPV obtained using the higher rate. Let's look at an illustration. Take a minute to go through the question. Very well. You notice that we've been told that a company is making a decision on whether to buy a machine at shillings 80,000. 80,000 is the initial outlay. Further, we are told that this machine would save 20,000 shillings per annum for the next 5 years. These cost savings are our inflows, and we notice they are annuities. An annuity is a series of equal annual cash flow. And then we are told the machine will have a resale value of 10,000 shillings at the end of its useful life. Now, this 10,000 shillings is what we refer to as terminal cash flow. Terminal cash flows are cash flows occurring at the end of the asset's life. And we discount them using the given discounting rate in the period in which they arise. Now, this company can only accept projects if the discounted cash flow return, DCF is discounted cash flow return, is more than 10%. And we asked to ascertain using IRR whether to accept or reject the project. What we do is to compute NPV first using 10%. And depending on the value that we get for NPV using 10%, if we get a positive rate, we try a higher figure than 10%. If we get a lower one, if we get a negative value, we try a lower one. I've tried to solve this question, and you notice that when we used 10%, the NPV is 2025. Since it's positive, we tried a higher rate, which ended up giving us a negative NPV of 2,230. Now, we'll apply those values in the formula that we've got. Our A, the lower rate, is 10%. NPV of A is 2025. Now, this is negative. But since the NPV of B is negative, we end up with two negatives and the sign turns to positive. Thus, our IRR is 10.95% or approximately 11%. How do we make our decision? Since our IRR is greater than the target rate of return of 10%, then this project would be accepted. Let's try another question. Again, go over it. Here, we are told that the company has a minimum required rate of return of 17%. And therefore, again, would have to compute IRR, NPV first using 17%. And depending on the rate that we get, we try either a lower rate or a higher rate. Again, I've solved this question for you. Using 17%, we end up with negative NPV of 1,159. And for that, we try a lower rate. In our case, I've picked 83. And by the way, you can pick any rate. We end up with NPV of 83. Then we try to solve the IRR, and we notice that we end up with IRR of 15.03%. Now, this 15.03% is less than the required rate of return of 17%. And therefore, this project should be rejected. Please take time to go over those two questions again until you get clarity. IRR has got certain advantages. And one of the biggest and major advantage of this method is more easily understood by non-finance managers. For instance, it's very easy to understand the meaning of the following statement. The project would be expected to have an initial outlay of shillings 100,000 and earn a yield of 25%, which is in excess of our target of 15%. However, we may not understand the following statement. The project will cost 100,000 shillings, $100,000, and has an NPV of $30,000 when discounted with minimum rate of 15%. So you notice IRR is easier to understand. Other major advantage is that it considers time value of money. Then the next one, it considers all cash flows in the entire project. Then it's consistent with the shareholders' wealth maximization goal. And it does not use cost of finance, unlike NPV, to discount projects. However, it has certain disadvantages. The first one is that managers may confuse it with accounting rate of return. Sometimes it ignores the relative size of investment projects. It's difficult to use. Sometimes it's also expensive to use, and it may give multiple answers. We've come to the end of this video. Thank you, and remember to subscribe to the channel Moya Kihuba for more.